Welcome back to Your Average Investor, everybody. Today I'm going to show you one of my favorite indicators for scalping, and it is the volume weighted average price anchored to the beginning of the day, or VWAP anchored to the beginning of the day. And there's two different ways to play this. We'll go over each of them. I'm going to start by looking at SPY because it's a great one to play it on, but after that we'll look at some individual stocks as well. Now let me explain what we're looking at here. I'm going to zoom in on this day. This purple line represents the volume weighted average price for the day. These lines above represent price bands above and below. So we've got, I believe right now I have it set to a quarter of a percent, a half a percent, and a full percent. We're going to look at this and I'll double check there. Yeah, so we've got a percent, a half percent, and a quarter percent. Yep. So this is a quarter percent above, half percent above, and 1% above VWAP, quarter percent, half percent, 1% below the volume weighted average price. So two ways to play the VWAP is one, you can wait for the price to move down, come back up right to the volume weighted average and play the rejection back down, right? So if the price has been trending down all day, when it comes back up towards the volume weighted average price, you play the rejection and scalp some options this way. This is where you'd play maybe, and again, this is not financial advice, but this is where you'd play like 0 day to expiration options, look for a very fast move for explosive profit, but also expect the price to go to 0 if you get it incorrect, which is why position sizing is so important, right? So that's one way to do it. And let me show you another way. The other way is what I call revision towards the mean. And what you'll notice a lot of times is if the price is kind of just like waffling like this and we have a down day, right? Eventually, at some stage, the price likes to revert back to the volume weighted average because institutions are buying and selling on the volume weighted average. And so if I'm an institution that's selling and the price is too far below the volume weighted average, I'm no longer going to sell until it comes back up, and then I'll start selling again, right? So in this case, we're about 0.5% below the volume weighted average, and there's a nice move back to the upside there. Now, the further away you are from the volume weighted average, the more likely it is that you'll see a reversion towards the mean at some point. This can be dangerous to play though, because just like any trade, there's no exact science here. If it worked every single time, then by virtue of working every single time, it wouldn't work anymore, because if everybody knows it's going to happen, well, then the market smooths out the price action, and the only people making money are the ones with the high frequency algos. So we're going to pull this out actually. I want to look at the last 30 days. We're going to look at a 30-day 1-minute chart. And we're just going to go back and look at a few examples of this so you can see some, and I'm pulling this randomly, by the way. I don't have anything set here, but just so you can see some examples, right? Here we go. We have right here, we see the price in the morning comes up 0.25% above, down 0.25% below, comes up 0.25% above a second time, a third time, and then moves back down, right? So you see this second one rejecting and this third one rejecting. This is a great time to enter short, buy some puts, and then capitalize on these puts as they move down. You could also play this the opposite way, of course, as you saw that on the 0.25% below, it started moving back up once, and you see that happen again. It comes back. So maybe around this time, you start buying some call options and play it to the upside. So there's one day. You can see it works pretty well, right? It's not a perfect indicator, and sometimes it won't be at the 0.25% line. Sometimes the 0.25% line won't mean anything. So we're just going to move forward to the next day. You can see it never quite makes it to the 0.25% below until the very end of the day, but it does come up above again. Here's at a 0.25%, kind of trickles down before falling, right? So you could make a nice gain on this move down here, and you could also make a small gain on the upside from the 0.25% below, back reverting towards the volume weighted average. And of course, this is only really applicable during market hours, pre-market, after hours. The volume is so drastically different that you're not going to see much of anything. This is a beautiful day. So this is the danger of playing VWAP scalping, is you could get a day like this where the price just slides down all day long, right? At any point here, if you try to enter calls, unless you just get incredibly lucky and time one of these really tiny bounces back, you're just going to lose money, right? So this is why position sizing is so important, because if you bounce, if you're super confident, like, oh my gosh, it was always bouncing at the the 1/4% for the last 2 days, and I'm going to put 40% of my account in a single trade, you're going to lose all your money by the end of the day. So this happens occasionally. You'll just see the price slide down and there's no real bounce back up. That's why it's important to wait for the confirmation. Here we go. Look at this. This is great. Something wild's happening today. This was 725. So you can see immediately sold off about a 0.5% below and then just rockets above. And then check this out, just at or a little bit above 1% above the volume weighted average. Big rejection, comes right back down to the volume weighted average before coming below, trying to recover one more time, and then having another massive sell-off. If you purchased put contracts here, 0 day to expiration put contracts, and held them not even until end of day, but just held them until you saw maybe this area here where it finally started recovering, this is probably an 800% gain in 0 DTEs. And that's where this is powerful, right? Is because you're going to have days that your trade goes to zero. Literally, when you're playing 0 day to expiration contracts, if you know, like let's just say as an example, I saw this come down and almost touched, and so I saw it come up here, and I'm going to play put contracts. So I buy put contracts right here for $50. They're going to be worth like $5 right here. And of course, by the end of the day, they'd actually luckily end up making money. But you've got to time 0 DTE just right, so expect a lot of your positions to be going to zero. Let's move on to the next day. You can see here just kind of the price is waffling, comes up to 1/4% back down, up to 1/4% back down, up to 1/4% back down, and then here, right? So like let's say here's another, this is actually a great example. Let's say you're planning on puts right here, so you bought puts thinking it's going to come back down. It doesn't until here, right? This looks great because this is at the volume weighted average again, but follow this line over, you'll notice the volume weighted average at this time is equivalent to 1/4% above the volume weighted average here. So the price moved back to where you started at. Those put contracts are going to have lost a ton of value to theta decay. Now by the end of the day, there were some points where the price was a little bit lower, but again, theta decay probably eats away enough premium that you're not going to make money if you entered put contracts there. So that'd be one if you entered puts, you just say, too bad, I messed up, And that's okay. Sometimes you'll miss trades. Let's move forward again to the next day. Here we have it again, waffling up and down on the 1/4%ers. This one goes down to 0.5% nearly before coming right back up to the 1/4%. You see it rejecting, rejecting, rejecting. So maybe sometime in here after so many rejections, you decide I'm going to play to the downside. You make a nice little trade there. And let's just fast forward. I'm going to fast forward to the most recent day, because I want to show you guys what kind of a movement this is, right? So this was on Friday, 8:30, and let's say you were watching the volume weighted average. You saw it bounce once off of this 0.5% below, and so you decided to get in right here on this 0.5% below bounce, and let's say you held it all the way till the end of the day, something like that. So you're going to buy just out of the money. That'd be the 558s. We're going to go to the trade tab here. We're going to look at the 558s, which are right here. Let me send these to my yellow chart, and here we go. Let me back out actually so we can see this overlay, right? So here it is. This is your timing right here. You're buying sometime right in here around $170 per contract. I'm going to make this one full screen now, right? So let's say you get in at like 170. You don't nail the very bottom, but you get in like 170, 180. You hold that till the end of the day, and now you're at $630. You've more than tripled your money, right? Even if you don't hold it till the end of the day, let's say you only hold it till here, and then you see, ooh, the price is kind of waffling, you get scared, and so you get stopped out or something like that. That's fine too. But still, that's 180 to like, let's say 250. That's a solid 70% gain or so right there, playing these 0 day to expiration option contracts off of this VWAP scalp. So again, position sizing is king. It's the only way you're going to survive if you're playing this, but it's an excellent indicator. I like playing SPY or QQQ on it, but you can also play individual stocks, right? Like maybe you don't want to play SPY because it's a big basket and you'd rather take a look at something like, I don't know, BAC as an example. I'm going to show you what this looks like. So we're on Bank of America right now. Bank of America, like most banking stocks, maybe we should look at JP Morgan actually. We'll start with Bank of America though. So we're going to look at Bank of America, and you'll notice Bank of America tends to stay within these bands. However, let me switch it to Tesla real quick. Let's just take a look at Tesla. You'll see on Tesla, these bands a lot of times are completely meaningless. The 1% above, look at this, 1% below just crashes through. Let's see if there's any more really drastic examples just off the cuff. I don't see. Oh, here we go. Right, way more than 1% above. So this is something, if you're playing individual stocks, it's a good idea to back test and go and say, you know what? Maybe what I ought to do is I ought to change these, so instead of being 1% above, it goes 2% above. And then you can back test this and see where does it seem like it normally reverts back towards the mean. Or again, maybe you're just playing the confirmation, right? So you see that it comes above, comes back down, and you're going to enter somewhere right around here if it touches the VWAP again to say, okay, this is a bullish day, so I want to play the continuation trend right there, right? So you see it waffles in the morning, strong move above volume weighted average, back towards volume weighted average, and then a strong move up past volume weighted average again. All right, back to BAC. Let's look at BAC and then we'll finish off the video. Hey, if you haven't already, guys, please subscribe to the channel. It does a ton to help us as we're working on monetizing this thing so we can do a bunch of giveaways in the future. But here's BAC, right? So 1% below, nice move back up, just straight through the volume weighted into almost a full percent above, maybe 0.75% above, right? This move here doesn't look that big in dollar amount, right? You went from $42 to $42.79, but the option contracts on BAC, I'll show you. Let me show you on the most recent day. That's not a good day. We're gonna have to game this one a little bit. Okay, let's go here. So let's say you bought here puts, and then you're playing the downside down to here, right? Let me show you what this looks like with BAC puts, because BAC doesn't move all that fast, and so contracts are often very cheap. So we're going to look for, what are we looking for? The put 40, and we're going to have to change the, actually we can do, yeah, we'll do the put 40 right here. Here we go. So here's the put 40. Back to my charts, and let's see, I'm going to have to move this out to be 30-day 1 minute, and we're looking for right here. Oh, I grabbed the call 40. Whoops, let me switch this to puts. Okay, there we go. We've got the put 40. 906. Right about here. All right, here we go, right? So right about here, and you can see, look at that nice little volume spike. Someone's playing the VWAP scalps. Right here, you can see you got these puts for about 60 bucks. And here, where it bottomed out, these puts are now worth $84, right? So you just made a nice 33% gain over the course of about an hour or two playing that. And then, of course, by the end of the day, the price recovered some. And so these puts are, I mean, you'd still make a little bit of money if you held it till end of day, but not a ton. And then the next day, you know, it drops back down again, so you could have made some money again. But almost never am I going to hold these overnight. And, of course, playing BAC, there's not always going to be 0 day to expiration contracts, which is another reason I like using just SPY or QQQ for this, because you can really play those 0 DTEs for just absolutely monster swings, like huge, huge swings. I mean, you saw this one here. It was like a 350% swing if you had held till close. So thanks for watching, everybody. Hope this was a helpful video for you all. This is a custom indicator that I've made. So what I'm gonna do is I'll share this, and I'm just gonna put this, we'll call this Daily VWAP Scalp Bands, something like that. And I'll share this in the description. So if you guys want to upload it to your Thinkorswim, feel free to use it. Let me know in the comments if you have any questions. Catch you next time.